Good morning. Welcome to today's webinar, IPO Reality Check, How Finance Can Lead by Removing Roadblocks. If you're attending this webinar to receive California CE credit, please note that if you meet the requirements, which I'll go over in a moment, that you will receive an email within 3 business days with access to your certificate of completion. So let me go over a few housekeeping items before we get started. We think we just skipped the slide, but no worries. I'll go through a couple of things. You can maximize or minimize the webinar pane during the presentation by using the red arrow buttons. During the webinar, you'll also see a little enter a question box at the bottom. We'll be answering questions either during the webinar or if you don't have time, we'll be answering them at the end. To ensure you have the best audio quality, if you're using the telephone, please click the Use Telephone Audio Mode. If you're listening through your computer, then please click on the Use Mic and Speakers option. Now let's look and see if you can qualify for California CE credit. You must be using a personal computer, no PDAs, and log in with your own information and a unique URL. You must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. You must actively respond to at least 75% of the polling questions. We have 4, which means you'll need to answer 3, and you must complete the evaluation survey at the end of the webinar. Now let me get started by introducing our presenters. First up is John Dunnican. He is a partner with Armanino's CFO Advisory Services. He has more than 30 years of financial operations and consulting experience, working with public, private, and pre-IPO companies. Prior to consulting, John led finance teams as a CFO, VP of Finance, and Controller. He also has extensive management, financial, and operations skills relating to all financial functions, process reengineering, SEC and investor reporting, M&As, and cost reduction programs for technology companies. Our second presenter is Jeremy Suharski. He is a partner and head of our governance, risk, and compliance team. He graduated from California State Polytechnic University, San Luis Obispo, when he brings more than 13 years of experience building and managing teams focused on various internal control-related projects, which include internal audit, Sarbanes-Oxley, readiness and compliance, process optimization, and business continuity. And finally, let's look at our learning objectives for those of you who are trying to get CE. So during today's webinar, we will discuss the essential pre-IPO tasks required to meet S1 filing requirements. We'll review how to avoid close scrutiny from the SEC, investors, and the stock exchanges once public. And we'll also identify restatement risks and how to avoid a 3-year drop in investor confidence. And with that, I'll turn it over to Jeremy.
Awesome. Thanks, Debbie, and good morning, everyone. Thank you for taking time out of your morning to spend some time with us and talk about IPOs, not only what's going on in the market, but what are some of the ways in which you can be most ready for an IPO. And really, the key thing that we're trying to bring to the table today as well is not just how to get to an IPO event, but really what do you need to do with your people, process, and technology post-IPO to ensure you have continued success. So we're going to start off by talking about what is the IPO landscape. There's been a lot of talk about some of the market slowing down earlier this year. Is it really as favorable for investors as it was, say, for the prior 12 months? So we're going to talk a little bit about what that's looking like and really why IPO readiness should continue to be a top-of-mind topic. We're then going to talk about how you MacGyver your IPO. And for those of you that, like myself, were either a product of the 1980s or were alive during the 80s, you know that MacGyver was a big TV show then, and he could build you a plane out of 5-gallon drum of mayonnaise, 2 pieces of chicken wire, and a pencil. So we're going to talk about how you apply some of these similar concepts to your IPO, and then last but not least, how do you as key finance leaders in your organization avoid the hot seat post IPO? So let's go ahead and jump ahead here, and we're going to kick it off by talking about starting off with our first polling question.
Thank you, Jeremy. So an easy one for you, no background needed. Just let us know, what is your IPO or liquidity time frame? Is it A, 6 to 12 months, B, 12 to 18 months, C, 18 to 24 months, D, undecided, or E, not applicable? And while you're listening to our presenters today, I'll just let you know that you will be receiving an email from me after the webinar with the slides. So you can feel free to take notes, but we will get you these slides after the webinar. And we'll close the polls here in maybe 2, 1, and close.
And these results are pretty interesting here. We're going to put them up on the screen. There we go. So it's actually pretty consistent with what I would expect to see given the nature of what we're talking about Not surprising that nobody's in the 6 to 12 month bucket, and most are clustered in sort of the 12 to 24 month bucket. Really consistent with what we've seen with prior webinars, and this is our third consecutive year of doing this type of content. And we commonly see that folks are starting to look at, or at least consider IPO as a liquidity event somewhere between 12 and 24 months. They recognize either through their own knowledge or through board interaction that is the trajectory that they're on for an exit strategy as opposed to acquisition or some other type of liquidity event, and they need to be thinking about it. Now, really where we're going to shift the paradigm a little bit is talking about really when do you stand on the accelerator and truly go through the IPO readiness process. We'll talk about that here momentarily. So let's start off with talking about really what is the view from the top, what's happening in the current IPO landscape. You know, if you look at the couple of charts here, I'm real visual, so you know, for me, pictures speak far louder than words. Two different graphics. The one on your left is IPO filings. You know, over the last handful of years, and you can really see very reflective of what was going on in the economy. Very, very strong filings 05, 06, 07, and then from there really tailed off significantly into 08 and 09. And really we've seen a pretty good resurgence coming into this year. We bounced back significantly in 2013. You can see as of August 18th of this year when we ran this report, you know, we'd nearly matched the level of IPO activity from the prior year. So all indications from both reports as well as analyst insight is that the IPO markets continue to be favorable. Now, what you will see, though, is as we turn to the right and look at by month, the last 18 months, you will see a little bit of a dip earlier in the year, and this is really reflective of what we saw in our client base, specifically around technology industry, is April, May tended to be a little bit soft for the market and was not necessarily as favorable for IPOs, et cetera. And we saw several companies that we've been working with that were on an IPO trajectory dial back those efforts a little bit and start to take more of a waiting game or waiting approach. I will say a little surprising that July wasn't higher, and we are yet to see what the final August and September results are going to be. But again, really this comes back to the fact that all indications are that the tailwind that the IPO markets have had for the last 12 or so months will continue to be strong, and we're going to really carry a really good momentum through the remainder of this year and into next year for the availability of capital through these mechanisms. Now, if we look at it differently, the question would be what are the key industries where the IPO money is going? And you can see here, healthcare year to date has been the largest, with technology being the second largest. I would say this is interesting. When we did this presentation last year, it was very much the opposite. Energy and gas was the number one, followed closely by financial, and technology was actually sort of in third place, if you will, with the third highest volume of IPOs. So this is encouraging, especially for Bay Area companies, because if you look at healthcare, that also takes into account life sciences and those types of industries as well. Very, very rich in the Bay Area with companies with this type of intellectual capital. And of course, technology, there's no better geography than the Bay Area and Silicon Valley for tech companies that are up and coming. So the great part is, if you really look at it, 50% of, give or take, 50% of all IPOs are very much in the market segments that are very, very rich in Silicon Valley and very, very favorable. Other points to note, various reports point out there's about 590 investor-backed private technology companies, so you can look at that. Even if you figure 20% of those are going to be achieving some type of liquidity event in the not too distant future, you can see that plays very favorably for technology companies as well. So we've kind of established the baseline that the economic environment for IPOs continues to be very positive. And going back to our first polling question, a lot of you on the line are looking at somewhere between 12 and 24 months for your IPO. And really what it comes back to is kind of potentially this mindset of, hey, we've got time, relax, we've got 2 years, we've got plenty of runway in front of us, and we're going to be okay to start this planning process. Now the reality is, you're going to be going through the process of operating your business, and of course IPO likely will be somewhere in the discussion, although it may not be at the forefront of the discussion. And the challenge that you run into is it is not uncommon for that 12 to 24-month time frame to suddenly become a 6-month time frame. And that's the reality we consistently see with organizations that we help with a variety of aspects of IPO readiness, whether it be Sarbanes-Oxley, S1 preparation, equity accounting, a lot of different areas. Really what it comes down to is we know that as an organization we are looking to have an IPO event in the not too distant future, and the board decides that the timing looks appropriate and we need to stand on the gas and get moving and finish up these last things and get to a public offering. And it's not uncommon for that time frame to be 6 months. I will say in some cases, and John, I believe you were involved in this project, in some cases we've seen that window be as short as 6 weeks to finish the S1 process and get that S1 filed and out the door.
Yeah, sometimes it does happen that way, and that obviously is kind of the worst case scenario from an accounting point of view, because it leads to very, very long nights and weekends to really try and crunch that out. I guess the other comment I would make in terms of shrinking timelines is, a lot of things we're going to be talking about today in terms of requirements from accounting and process point of view are true if you don't necessarily do an IPO, but M&A transactions tend to come up very, very quickly and put tremendous pressure on the finance organization. And that's true whether you're the buyer or the seller in the transaction. Likewise, you may suddenly find yourself in a position of needing to go out for additional financing from a VC or a private equity group, or financing from a bank or other institution might be doing a loan agreement or financing of some type. So a lot of these same issues can come up in those environments too, where while you think you've got time, all of a sudden you don't, and you suddenly have a transaction or event you need to get ready for very, very quickly. And a lot of the same issues we're going to be talking about become applicable, because a lot of the same information is needed.
Yeah, absolutely, and that's a great point. It really transcends IPO, and it really can be same concepts apply to John's point. Same concepts apply really across all types of liquidity events. All right, so let's jump ahead and jump into polling question number 2 to help set the stage for the next topic.
Thank you, Jeremy. So polling question number 2, again, you don't need any background for this one. So what is your experience level with taking a company public? Have you taken A, 2 or more IPOs, B, 1 or more IPOs, C, are you gearing up for your first IPO, D, are you researching the process, or E, none of the above? We'll give you a few seconds to answer. And again, if you're trying to get CE credit, you'll need to answer 3 of our 4 polling questions. This is number 2. And we'll close the polls here in 3, 2, and 1.
All right, and this is again consistent with what we've seen in prior years and what we're very accustomed to seeing in the market, especially with newer startups, tech companies, etc. Occasionally, we run across CFOs, VPs of finance, corporate controllers that have helped take several companies public, but the majority of the time, it's either somebody has been through one IPO or is gearing up for their first. So sort of that bell curve there, with the majority of the responses in the middle. Really is consistent with what I've seen in my client base. John, what are your thoughts as well?
I think that's right. The nature of what we're doing does tend to be more for CFOs that haven't done it yet, as opposed to those who've been through it several times. And even it's also interesting that you've got a fair number that are just researching the process. So I guess that's those of you that are not quite there yet, or none of the above, where you just whether you're just rooting for CPE or CE or whatever, which is fine. There's a lot of good information, and for those just researching a process or kind of the none of the above category, hopefully you get a lot of good information out of it. As I said, a lot of times this is not just IPO related, but other transactions as well.
Excellent. And that's helpful to frame the level of discussion that we're going to be going through here. Talking really about how you do your pre-IPO MacGyver style. And again, we said, look, in the perfect world, you're going to have 18 to 24 months to execute these. But the reality is it's most likely going to be 6 months. And it was really put to me best by one of the CFOs we do work with as they were gearing up for an IPO, and as this individual's first time taking a company public. While this individual had worked in public companies the bulk of their career, they had not been in the driver's seat as a CFO. And he said, look, at the end of the day, I don't want to be the one getting in the way of our success as a business, specifically delaying the process to become a public company. So I need to make sure I'm doing everything I can to accelerate the process and really to get out of the way of the business and make sure we're supporting it. And so that's why this idea of MacGyver really came to mind, which is, and Peter Thornton, who played MacGyver, he said, look, his name's MacGyver, he could fix anything. He could fix a computer with a hairpin and a piece of duct tape, which if you recall the show, that's really what it comes back to. The same idea really is applied to IPOs. You think about in a perfect timeline and a perfect cadence, all the various things that you would want to get to or need to get to. The reality is you're not going to get to all of them. So it's looking at how do you balance scarce resources with a very, very long list of items that need to get done to get out and become public, and then also what are the other things that are nice to haves as part of that process. So let's dive in and start talking about those. So as I mentioned, we've talked about this mythical 18 to 24 month timeline. You look at things like establishing corporate governance. This is one of the most basic things. The board that helped get you to the point you're at may be comprised of various individuals from private equity, from venture capital, et cetera. They may not have the right skill sets, background, skills, knowledge, and experience to be serving on a public board. You may need to have somebody with more who can be considered your financial expert as required to be a public company. So you need to look at what your governance is, establishing board qualifications, getting your independent directors in place, starting to understand your risk management considerations, determining if ERM is something you guys need to look at. One of the key areas you're going to need to look at as well is assessing your finance organization. I'll say the two sort of barriers to success that we commonly see, sort of bookending process, is going to be your people and your technology or your systems. So assessing your people and your organization, determining where extra skill sets are going to need, determining where extra bodies are going to be needed to scale along with the business are going to be significant. From there, you're going to look at optimizing your financial processes. Again, you need to look at how do you enable these processes with leading edge technology, and how do you make sure that they are going to be able to move as rapidly as the business. And in many cases, how can you deploy these globally? I will say in all the cases where my team has assisted various organizations in the past 18 to 24 months with companies getting ready to go public or companies that are newly public, in all cases, they've really had to take a critical look at this area because all of them have international operations that they had to scale. So not just in the U.S., but really had to scale these processes to support a global organization. From there, you build out your financial reporting capabilities, and this ties directly into what I mentioned around skill sets. You need to look at who are the individuals you need to bring on board and then what are the supporting technologies to ensure that you can do quarterly and annual financial reporting. You can have quick and reliable financial planning. You make sure that you go through SOX readiness and making sure that you have something sustainable from an internal controls perspective. You go through the S1, you do investor relations. There's all kinds of different things that you need to have done, and this is in a perfect world. And I will say occasionally we have clients that do have a very long timeline to get out for a public offering. In some cases really has been 18 to 24 months. The reality is, as we've talked about, is it's really closer to 6 months. So what are those bare minimum things you need to look at? Well, number one, you need to optimize your financial systems. And again, this is to support scalability of the business. You can add people and throw them at the process, but if your systems cannot support that scalability, you're setting yourselves up for failure. I've seen this time and time again where companies continue to throw bodies at a problem, but they're throwing bodies at a problem that really can be solved by getting off of Excel and getting onto an enterprise system, whether it be for more automation of their revenue process, whether it be having a more sophisticated budgeting and forecasting solution, whether it be consolidations, procurement. Throwing bodies at a problem is not always the answer. It's looking at what is the root cause that's preventing this from being truly streamlined. And in most cases, we find it's a technology issue first and foremost. The next one you need to do is look at building out your financial reporting capabilities. And we touched on this just a moment ago. And it's really looking at, do you have the individuals with the right skill sets on board who can take you through this? And in most cases, if you're a first-time CFO, getting ready to take a company out, you may have been the one who had this expertise in the past, but I will say from experience working with companies, you are going to be in a very different role if you are the CFO. And John, maybe you can speak to this a little bit too, but if you've been the one in more of the technical accounting seat and now you're in the driver's seat from a CFO perspective, my sense is that you're going to be spending less and less time on the actual accounting and more time on investor relations.
I think that's right. We'll talk a little bit more about some of the requirements and stuff in a few minutes. But if your role is the CFO, I mean, most of your time is going to be spent working with the investment bankers, working with the investment community, investor relations, and you're really going to need support from others in your organization to really do the financial statements. Hopefully you've got a strong controller. A lot of organizations do not. And often what ends up happening, which often makes sense from a financial point of view, is you're going to outsource a lot of that initially. Until you become a fairly large company, it's hard to justify the cost of having full-time in-house expert capabilities in SEC reporting and some of these things, so it makes sense to outsource it. But you're definitely going to want to be looking at additional resources, because if you roll a CFO, you're simply not going to have the time to do it. You're going to get pulled into a whole lot of other things. I guess the one other thing before we could talk a little bit about the preparation of the statements themselves, although we kind of grade it out here, is because often it falls on the not in the CFO, but that is the independent directors, because that is a requirement. You can't, to be registered with the stock exchange, you have to have those independent directors. I don't want to lose that, although typically, as I say, that falls not to the CFO's responsibility, but to the responsibility of either the board members, a lot of times the investment bankers, or your corporate counsel will often drive a lot of that. So so that's not necessarily, it is a requirement. It does have to be done. I just wanted to make sure that was kind of clear, but it just typically is not on the CFO's shoulders to get that done.
No, absolutely. You beat me to the punch on that one, John. You're absolutely right. While it is a requirement, it is rarely the CFO's responsibility. It's an organizational requirement, commonly driven by the board or by the general counsel. And then the last area that John alluded to as well is getting through the registration statements, going through the drafts of the S-1, addressing SEC comments, preparing the prospectus, and all of these really feed into the investor relation process, as well as sort of the baseline blocking and tackling, getting ready to be a public company, and going through the registration process. So really, if we had to boil down that 18-month timeline, these are really the areas that if we're in the CFO seat or if we're advising a CFO, these are the areas you need to focus on first and foremost to make sure that you've got a successful IPO, and not only just to get to that IPO event, because keep in mind, your IPO is a single day in your company's history, and while it's very important, it's a big catalyst for big things to come, because you're getting ideally a large influx of capital that can help springboard the business, et cetera. It truly is one day in your company's history. So really, this is setting yourselves up for long-term success. It's not just to achieve the IPO and then you're done. It's kind of like, hey, we finished the regular season, now we're getting ready for the playoffs. You won the game, now you're in the wild card. Unfortunately, it's the Giants and not the A's, but kind of using that same analogy, it's getting ready for something that is bigger than what you just completed. And that's why these things are of paramount importance to set you up for future success.
I think that's right. As we begin to talk about some of the S1 preparation, it is important to remember that the S1 and the IPO, while it's a huge event, it is a single event, and the real fun begins the day after. Because you've got through the IPO, and there's a whole lot of stuff you need to do after that. And I want to talk about a little bit of that now and just kind of give a little bit of the heads up on what the S1 is and some of the information that's required immediately after that. As you're probably well aware, the S1 itself focused on the finance role and the financial statements, the F pages. The Jobs Act for most companies, emerging growth companies, requires 2 years audited financial statements. What we're seeing, though, in reality, is most of the IPOs we work on is they're still going with 3 years. Particularly if the company's unless the company has a very short history and only has 2 years of meaningful history. But if the company's been around longer than that, which most have, the market does like to see 3 years, and most bankers seem to like 3 years. So I think there's a strong possibility that you're going to need 3 years of financial statements, 3 years of audited financial statements when you do the S1. I just have another comment up there that, of course, you need to keep in mind that we'll talk about what happens post-IPO and how that money tends to be used in a few minutes. One of the big items, though, is a transaction, as in a lot of companies right after the IPO tend to acquire another company, which then ends up with a registration statement related to the transaction. And that can be up to 3 years of audited financial statements. So even if you're in a situation where you only do 2 initially, you may find yourself very quickly needing that 3rd year. So you want to be ready for that. It depends on the various tests. We're not going to get into that whole thing about acquisitions in the test, but there's a net asset test, an investment test, income test, which all kind of drive how many years of audited financials you need. But keep that in the back of your mind that what you do immediately after the transaction is very, very immediately after the IPO is very, very important. And of course, immediately after the IPO, thing you do know you will have to do is start filing 10 quarterly data and 10 Qs. So you're going to need that going forward. But in the S1 itself, there is quarterly financial information often provided. Now, it's not strictly speaking required for the S1, but you typically will see it. The investment bankers usually like it. And if you do 2 or 3 years of audit, the financial statements, you'll often see the same quarterly information provided for the same period. So if it's 2 years of audited, you'll see 2 years of quarterly. 3 years of audited, you'll see 3 years of quarterly. So when you're doing that, it becomes very important to make sure you've got your quarterly financial statements, clean cutoffs in your financial statements going back those couple of years. Very often you're doing the audit adjustments. If you have audit adjustments at the end of the year, you clean up a lot of stuff at the end of the year. Now you need to go back and really flow that information back into all into the proper quarters. Especially even with the even if you're not going to put it in the S1, it is required for the 10K, 2 years. And like I said, if you do a transaction, a merger and acquisition, something like that, you're going to need the quarterly data in that case as well. So you definitely want to go back and look at that quarterly data, make sure it's clean, you've got good cutoffs. And that can be a lot of work because typically private companies are not real focused on clean cuts on the quarterly numbers. Of course, you're going to need to start breaking out segments if applicable. Private companies rarely, if ever, break out earnings per share, both basic and diluted as applicable. So that's something else you're probably going to have to do for the first time, and that's just a disclosure and things you may not be very comfortable with or used to doing. And of course, then there's always XBRL, which is purely a public company event. Don't underestimate the time that's going to take the first time through for your S1 to do all that tagging. A lot of software out now has made that a lot easier, a much smoother process. But it is going to take time, and you better allow for that because you're going to have to, the printers are still going to probably need, 5 or 7 days, pencils down for them to get that all done. So if you've got an IPO date set in the banker's mind that you're trying to hit, you got to kind of back that up at least a week for XBRL and tagging. You want to give them that amount of time.
That's great, and I was just going to ask John, if you could provide input on what that timing is. So 1 to 2 weeks is really kind of what you're suggesting is pencils down 1 to 2 weeks in advance of that date, however it's been set. Yeah,
you better plan on at least a week. I mean, you can certainly make changes up until just before you file, but you want to make sure you have a good week, and that's what the printers are going to recommend that you do.
Excellent.
A couple of other things to think about for S1 preparation, and I wanted to bring these out specifically because they often end up being kind of a long pole in a tent, because if you let them go till the last minute, because they can take a fair amount of time, and that's updating valuations. This can often take, they said, this could take a week or two to get this done, and this becomes critical information, particularly equity compensation. It's very common. You can expect the SEC to really ask you about that. A typical comment from the SEC would be, from the estimated IPO price, including the registration statement, they're going to want you to reconcile back and explain the differences in the fair value of your common stock you use for stock options and stock grants, probably back to when you first really started talking to the underwriters and investment bankers. So if you've been talking for 6 months or something, they're going to expect that value is baked into the stock options. Because you really want to avoid the whole cheap stock problem. So you want to get in front of that and make sure that you have that information of valuations updated with all the relevant information. And that can take a fair amount of time. Likewise, derivatives, if you have level 3 financial instruments, and those are the ones that have no observable inputs. These are just things that can take a lot of time. Typically, you're relying on outside experts to do it. They're going to be often looking for financial forecasts and budgets to do that information. So you just want to, again, it's one of these things you want to make sure you're in front of, you're aware of, because you don't want to have to be, getting near to ready to file the S1 and you're still waiting to get this information, because the auditors are going to spend a lot of time on it. It's an area that's very subjective, and you can expect, a lot of discussions back and forth. So it can be very, very time consuming and can be a real time sink for you and your organization.
Hey, John, before we jump forward here, one question we did get from somebody that's relevant on this last slide that we talked about is if we could define XBRL. And maybe I can jump in a little bit with that, and then you can kind of come behind and provide sort of
Sure.
the layman's interpretation of what it is. So XBRL is the Extensible Business Reporting Language, and really what it is it's an extension of XML, which is a computer programming language. Effectively what it is a way in which you can tag documents that allows for a uniform exchange of business information. Is really, if you were to look at a formal definition of what it is, simply a way that computers can exchange this information in a consistent format globally.
Okay, I guess, yeah, what does that mean in English?
Yeah, that's a very sterile technical definition, I'm sure.
So in English, for those, if you've been doing SEC reporting for a while, until a few years ago, you would just send in your SEC form, whether it was an S1, 10K, 10Q, whatever it was. You would essentially submit it to the SEC and you were done. A few years ago, the SEC started requiring all of the numbers within the document, and it's not just the core financial statements, balance sheet, cash flow, income statement, statement of equity, but all the footnotes, all of the MD&A information. All those numbers need to be tagged with a very specific label that is a predefined label that the SEC has established. So you have to go through every line in the financial statements and tag all of those with the predefined amounts, as I said, predefined labels. And the reason for that is so that analysts, it's really to help the analysts and the folks doing the research so that they can go through very quickly and compare your company to similar companies, similar industries, and they have the ability to go in, like anybody has the ability to go in from the SEC website and pull all kinds of information across many 10Ks, 10Qs, S1s, 8Ks, whatever else is filed, and compare data. So that process, that's why it was set up to make comparisons much easier, much more readily done. It does make it a lot easier if you have to do research, but it puts a fair amount of onus on the finance organization to go through and make all those labels and label all those numbers so that information is available to the analysts.
Yeah, absolutely. No, and that's a great. I guess I was coming at it from the IT perspective, and that's probably a better description of really how it's used. Excellent.
So one other thing, another area I want to kind of focus on a bit with the S1, because it's an area that often takes a fair amount of time the first time through, and that's really the MD&A. The MD&A is a management disclosure and analysis. Essentially, for those who haven't done it, it's not technically part of the financial statements. It's not in the F pages. The auditors do not opine on it, although they will definitely review it and read it. But what it is, it's management's discussion of exactly what the results are, why they are. The SEC looks for it to be in very plain English. It's an area that gets an awful lot of comments from the SEC. But it really is, it's explaining, why your sales are up, why your sales are down, changes in expenses, what you expect the numbers to do in the future. And it's very much a kind of a verbal discussion. One of the interesting things is it's usually written in the first person. So management's talking about, this is what we're going to do. The company, instead, as opposed to footnotes, which tend to be always third person, kind of the generic, the company did this or the company did that. The MD&A is usually, in the first person, this is what we did, this is why we did it. And so it's very much a discussion. It can be many pages long and fairly detailed. So something you want to really start practicing, quite honestly. So it's a good idea when you're preparing your monthly or quarterly financial statements ahead of time to start kind of writing up that summary for management of why the results are what they are. It really helps when you're doing the S1 and the follow-on 10Ks, 10Qs, to really kind of make that process go a little easier. It really kind of ensures you understand the changes in the financial statements. And ultimately, it's for the investors to make sure the investors and the equity holders, the stockholders, understand what's going on in the financial statements. But it is an area that gets an awful lot of scrutiny from the SEC. And I guess the other thing to keep in mind as you're doing this, for those of you, the CFOs that have CEOs in management that like to put out press releases and do speeches and PowerPoints and all those kinds of things, the SEC, be aware, the SEC will absolutely compare what you have in your MD&A to what you have on your website, to the last speech your CEO gave or one of your investors gave. They will look at your press releases and compare that to what's in the MD&A. And they will flag differences. So if you've got a press release that says one thing and your MD&A is not consistent with that, you absolutely can expect a comment from the SEC to come back and and flag this. It's something you want to get used to working with. You want to be really careful to how you prepare that.
Excellent. And so jumping into one other area that, part of the S1 prep we touched on was systems related, getting the right financial systems in place, et cetera. And a big piece of that is not just getting them in place, but also cleaning up what you have. You may have the appropriate tools, but they may not have been managed appropriately. The data may not be as consistent as you want. So really the first thing you need to do is evaluate your accounting system and make sure you're implementing a real accounting system. And by that, we're looking at something that's enterprise class. Well, there's various products out there that are geared towards small and medium-sized businesses. Really, you need to be looking at something that is going to be appropriate to the scalability of your organization that really can support not only the processes but the internal controls necessary to operate like a public company. Updating all your account reconciliations, making sure these are being done on a consistent basis. I will say most organizations we come in and start working with on pre-IPO activities, when they start looking at reconciliations, it's a lengthy effort to get those account reconciliations up to date and current if in fact they have been sitting on the back burner for too long. And so looking at what the subledger systems are, cleaning up all of the vendor files, accounts payable, accounts receivable, et cetera. Lots of work goes into this. So it's something that, and there's really no magic bullet for it. It's simply churning through it. It's going through the exercise and having somebody heads down working through those reconciliations, and it's something that absolutely then plays into providing accurate financials to the auditors for their various audit purposes. So really focusing on this early in the process, and then not only just getting it cleaned up, but making sure you have the processes in place to ensure it stays cleaned up and it stays trued up. And this accounts for roll forwards as well, equity, fixed assets, et cetera. Really looking at a variety of areas and ensuring that the appropriate things are in place, et cetera. And really making sure that your systems, again, not only are cleaned up, but are going to support the process going forward. And the piece that bleeds right into that, as I mentioned, you need to be looking at what are the things we need to put in place to ensure that once we've invested the effort to establish a baseline, it remains appropriate. And as we look at that, you want to really look at beginning the SOX process. Maybe not going full boat, but you really want to be looking at starting to document what are the issues, what are the processes, what are the remediation approaches, and really starting to gain a deeper understanding of your control environment. Your control environment is going to help take some of these baseline activities that you do and help ensure that it's going to be consistent going forward, so you don't have to come back and effectively repeat some of the manual work that you had done previously. And then last but not least, really trying to reduce as much as possible any disparate systems. Making sure that you have an integrated systems approach, an integrated control environment is going to be significant to ensuring that you have the appropriate scalability both of systems and of your internal control environment.
And now we'll do our third polling question. The greatest percentage of IPO cash proceeds are used for which of the following? So this is post-IPO. Is it A, capital expenditures, B, dividends, C, research and development, D, mergers and acquisitions, or E, you're not sure? We'll close the polls here. We'll give you a couple more seconds in 3, 2, and 1.
Okay. So as the results come up here in a moment, in this group, most people are thinking that it's going to go to R&D, followed by, for the answer they were actually given, mergers and acquisition, CAPEX, and there's a group that's not sure. It's probably a reflection of this group tends to be a little more Bay Area centric, a little technology centric, or medical device biotech centric, which probably makes sense for that group. But if we jump to the next slide, we can actually see how the cash is actually used most of the time. CAPEX is the number one use of cash overall for all IPOs. But if we look at the actual results across all IPOs for the last through about this time last year, CAPEX is the single biggest use with 33%. Buyback of stock is about the second with 22%. followed by dividends, M&A, and R&D. R&D is actually the smallest of the uses, which I find a little interesting, but that is the way the number goes, I guess. I guess nationally that might make more sense than it does here in the Bay Area. But this is a good idea of how the money is used. Some of these activities put a lot more stress on the finance organization than others. Buybacks and dividends don't tend to stress out the finance organization quite so much. CAPEX certainly can. M&A absolutely does. So if you're doing an M&A immediately after your IPO or very shortly thereafter, that can put a lot of stress on the finance organization, as can R&D.
Yeah, no, absolutely, and I think that's really the important point, John, is this is really intended to bridge the gap between getting ready for going public, and then what happens, as John mentioned, you wake up the next morning and now you're a public company, then what happens? Well, first and foremost, you've got a huge influx of capital if you had a successful IPO, which most companies have as of late, and now what do you do with that, and what does that mean to the finance organization? Just pointing out really where CAPEX and M&A really can put a strain on a maturing organization, especially M&A. We've seen this across our client base where acquisitions have been executed very shortly on the heels of the IPO. You take an organization that is working to mature as an organization to meet these various SEC requirements, now double the size of the company, triple the size of the company, have more diverse operations, both geographically as well as maybe products, et cetera. It can put a significant strain. So this really is in the vein of looking long-term and looking beyond just the IPO as an event and say, well, what are the other things that you can do pre-IPO that are going to influence your long-term success?
Right, as I said earlier on, a lot of things we've talked about so far have very much played into that in terms of systems and processes and making sure you're ready, because the same skills you'll need for the IPO are applicable in some of these scenarios, particularly like we've talked about the M&A if you go out and acquire a company. I want to spend just a couple minutes on what happens if you don't get those financials filed on time. So you do the S1, and now you've got to file your 10Q, often within a very short period of time thereafter. If you happen to file your S1 late in the year, especially if you were going to do it like now, you'd be coming up very rapidly on a 10K. So there are I'm not going to spend a lot of time on this. There are some different groups that have different reactions from the public, the SEC, the stock exchanges, and others. So just looking at these real quickly, public scrutiny, obviously, if you miss a filing deadline, it's going to significantly raise the public scrutiny of the organization. A press release announcing failure to file timely always raises all kinds of concerns, insider trading, and all kinds of other kinds of issues. The public gets very nervous when you don't file on time. I should make the point here that, of course, if you're going to be filing late, you can file an extension, request for an extension with the SEC. It's an automatic 15-day extension, doesn't require an explanation. It's rather like the automatic extension you get for filing your tax returns, kind of a deal. The important thing about it is, of course, if you file the extension and then file within the 15 days, you're not considered to have filed late. So you're still considered a timely filer. So all the things we're going to talk about go away. I've actually had a couple of clients on a couple of occasions where we've actually had to file for an extension because, of course, here on the West Coast, the cutoff is 2:30 to file timely. Where we've filed for the extension at 2:15 or something, and then actually filed the actual documents by 3 o'clock. We just, for various reasons, we knew we weren't going to make that 2:30 deadline. Filed the extension as soon as we got confirmation the extension was received. We turned around and filed the document very shortly thereafter. Not the process I would recommend by any means, but if you are really pressed for time at the last minute, it's always kind of a last minute option to do that. On the stock exchange, there are things that can happen with the stock exchanges. First, if you file late, New York Stock Exchange, they're going to monitor you very closely for 6 months. That, of course, that's going to stop once you do file timely. If with the NASDAQ kind of is the same thing, you have a 60-day compliance requirement that can be deferred up to 60 months. In a really, really extreme scenario, you can be delisted, but at a minimum, you can expect both NASDAQ and the New York to significantly increase their monitoring of your activities and what you're doing if you file late. On the SEC side, you know, you can lose the ability to do a shelf registration, which is Rule 415. That would be if you're planning to do subsequent offerings, you can lose that ability. Do it as a shelf registration. You can lose safe harbor rules 144, which restricts management's and officers' ability to sell their stock. If they're holding stock, they can lose the ability to do that. The SEC, of course, will begin to look at things a lot more closely, and the SEC, you know, can also take away your registration. They can suspend your trading in extreme scenarios. That's kind of the worst case. But all of these things are things, of course, you want to avoid if at all possible. You don't want your organization to be the reason the company is having trouble raising money, going to the public markets, and getting a lot of bad publicity because a finance organization can't get things filed on time. Of course, there's also affirmative covenants that many companies have with investors, lenders, trustees. If you've got debt covenants, they often do require timely filing. And if you're not filed timely, your lenders, your investors, particularly lenders, you can be in default, and they can call the notes in extreme circumstances if they don't feel like giving you a waiver. So again, these are just things you want to avoid. That's why it's important to make sure you are filed timely. So how do you reduce the risk of doing that? A lot of it is doing the things we've already talked about. It's implementing, as we say, a real accounting system. You know, if you're on one of the, some of the small accounting systems, I mean, QuickBooks is a great system for a private company. If you're trying to run your public company on QuickBooks or some of those real simple accounting systems, that can cause all kinds of problems. As Jeremy was talking about before, maintain the account reconciliations, make sure your subledgers are up to date. A lot of this is kind of the basic blocking and tackling of being a controller, but it is important to make sure you just stay on top of all this stuff. Hire or contract with a good SEC reporting specialist. If you're a small company, it probably makes more sense to outsource that on an interim basis until you can become large enough to really make that position worthwhile. Those positions tend to be fairly expensive people to hire. So unless you're fairly large, it's cheaper to just outsource it to an organization to do that for you. And of course, shameless plug, that is something we do for clients quite a bit. So that is always an option as well.
Thanks, John. And now we'll get to our fourth and final polling question. Question is, as a newly public company, you can expect additional scrutiny from A, investors, B, your auditors, C, the stock exchange, D, the SEC, or E, all of the above. And again, I'll be sending you these slides after the webinar. And if you do want CE and you have not answered one of the questions, please do make sure that you answer this question, as there are only 4 and you need to answer 3 out of the 4. And we'll close the polls here, I think, to keep us moving along in 3, 2, and 1.
Okay. And this is obviously, this really was a layup. It was intended to be. The answer is all of the above. As pretty much everyone got. It's pretty obvious once you become a public company. Your life as a CFO, as a finance organization, it gets a lot harder. Doesn't get any easier because you have a lot more people looking over your shoulder. So the answer is all of the above.
And with that, let's shift gears a little bit. We talked about getting ready for the IPO. We talked about how some of the scrutiny and how to avoid some of the scrutiny that's going to be coming. What happens if you do have an issue? So let's talk a little more about what we call the 3-year revolt here. So if you look at it, the data since 2004, 1,800 companies have gone public. It's a pretty staggering number of companies that have listed on public exchanges in the U.S. since 2004. Now, of those 1,800 companies, 1 in 3 have filed restatements, which I think is even more interesting and a very startling statistic. So when you look at it, if you're going to be one of those 30%, if we're playing baseball, you're in the Hall of Fame if you're batting in the 300s. Of course, that's not where you want to be if you're restating earnings or anything of that sort. So as we drill in and look at this further, really, what are some of those things that drive the restatements. We talked about how to stay off the hot seat, how to stay out of hot water, how to avoid that scrutiny, but the reality is 1 in 3 companies will fall into that bucket. And if you look at the restatement trends in terms of the top industries, well, unfortunately, one of the hottest industries is also one that has the most restatements, which is computer and software. We'll talk about some of the underlying reasons momentarily, but really, if you look at it, very, very important for companies in our geography here in the Silicon Valley and the Bay Area, because so many are very focused on these two verticals. Banking and finance, energy, again, those are some of the highest areas of IPO activity as well. Not surprisingly, there are also high activities in terms of restatements, etc. Now, really, when we drill into it, what are the real reasons? 50% are expenses, and this comes back to some of the key areas that John and I had already spoken to earlier in the discussion, specifically around areas of judgment and estimation. So it's going to be reserves, estimations, etc. John explicitly mentioned stock comp, that being a very, very highly scrutinized area of your financials that your auditors are going to drill in on a very, very deep level. Some of the other areas, depreciation, cost of sales, you can see the various areas. The one that I found to be surprising was only 14% was revenue, and this is something that, especially with multi-element arrangements, very complex revenue, I'm surprised that that number is not higher, given that it has such a focus in tech companies, specifically ones with very complex revenue recognition.
I think one of the interesting things about that is how long it takes to make those corrections. A lot of the expense ones are fairly straightforward to fix. Stock compensation can be the kind of the outlier in that. But revenue is kind of average of 8.5 months to get that right once you get it wrong. And that's really not surprising at all. We've worked with a fair number of clients helping them fix their revenue recognition. That can be a major problem. Financing is a big number. That's typically because a lot of those transactions are very, very complex. There's a lot of financial vehicles out there. The accounting rules are very complex. The transactions are very complex. So it's very easy to make mistakes. That's an area where you want to be very careful when you're doing that to make sure you get it right. But I could see, so that 23% doesn't really surprise me at all.
And I guess the other one that surprised me a little bit was that income tax was so low. I know that's one of the areas purely from an internal controls perspective that if you look at statistics around most common material weaknesses, revenue and income tax are two of the highest areas. So that being said, I was a little surprised that income tax was as low as it is. But to John's point, really the statistic here that's most sort of telling is how long it takes to clean up some of these areas. Revenue really being the one that you're going to have to invest a significant amount of time and effort to clean up. So really looking at it as not only getting ready for IPO and looking at where the areas of scrutiny, but these are some of the damaging effects that can happen if, in fact, you don't nail all of the respective areas of your financials.
I guess one other quick comment on the revenue is, if you're not aware, they've just issued all new revenue recognition requirements. They're not effective yet. They're actually effective for public companies in 2016, private companies in 2017. But there's something you want to start really thinking about. You want to get your hands on a copy of those new rules, really start looking at them, because they're going to impact what you're doing today is going to be significantly impacted by those new rules, and how, if you're one of those companies, especially that has longer term contracts, maintenance contracts, any of those kinds of things, those new rules will impact you. So you want to start looking at those, because you don't want to end up 2 years from now having to do restatements because you got it wrong. So that's just kind of a heads up to start looking at those numbers, looking at those new rules now, so you don't have those, can avoid some of those problems. So what does it mean to the investor's point of view? Well, it takes a lot of different studies, but basically it really takes about 3 years for investors to kind of forgive a restatement, particularly if it's significant. So you can expect your stock price to be depressed for kind of up to 3 years on average after a restatement. So it's an area of significant concern if you're the CFO. It's not something you want to do. Obviously, it's forgiven a lot more easily if it's a simple mistake and if it's straightforward, and you can quickly resolve it. It's like any other problem you might have. If you can bring forward a problem and announce what the problem is, what the solution is, how you fixed it, and the fact that it's fixed, it's a lot more forgivable than if it's a revenue item and you're going to be 2, 3, 4 quarters trying to get it right. That can really hurt your company. So clearly getting it fixed quickly and easily is very, very important, because you don't want those diminishing returns, that diminishing return problem. And to quote our old friend Ben Franklin here, it's really about an ounce of prevention being worth a pound of cure. You really want to stay in front of these things. The ways to reduce the risks and make sure this doesn't happen is a lot of things we've been talking about all along. Make sure you've got the expertise in-house and avoid complacency. We've talked about having the systems in place, the controls in place, proper accounting procedures. Doing all those things to make sure that you're staying on top of these things, and really look at complex transactions. If you've got complex revenue rules, if you've got complex financing rules, if you've got any types of significant transactions, look at them twice and really make sure you've got the accounting right. If you're uncertain, bring in some outside experts. It's a small investment to prevent an awful lot of headache in the future.
Yeah, and the last bullet point there was around, just don't forget SOX in COSO 2013. COSO 2013 being the underlying internal control framework just about every public company aligns to, either the 92 framework or the new 13 framework. The key point there being SOX, the whole intent behind the legislation and then the interpretation of it is to ensure reliable financial reporting. So anytime you've got a misstatement, it necessitates that there was a breakdown in your internal control structure. You had a weakness somewhere. You did not have a risk that was identified that had a compensating control. So I would argue use your SOX process to help find those gaps, determine where you have risk, and make sure you have controls in place operating at the proper level of precision to catch those items and ensure that you are not going to get burned to where you have this 3-year effect of diminished returns and diminished investor confidence.
Yeah, you can be sure you're going to get a material weakness if you have a restatement.
Absolutely.
It's a foregone conclusion.
It's a guarantee. There's no way you're getting around it. Excellent. Now, in summary, just to kind of circle back and close the loop here as we round the corner and head to home, today we discussed what the IPO landscape looked like. We talked about the importance of processes, the must-haves, both pre and post. And again, we were really trying to change the paradigm and not just take you through the 24-month plan, but talk about what are the areas of scrutiny, and then really what is the downstream effect? How can this really hurt you post-IPO? So hopefully you guys are walking away with some good nuggets that you can take back to your organizations, really focus on your accounting systems, focus on your process, focus on your people.
Yeah, and I guess, what I'd say in summary, as we said before, is, remember that the S1, the IPO is really just the beginning. Life gets a whole lot more interesting right after that. Unfortunately, the finance organization doesn't get to spend a whole lot of time celebrating the IPO because we have to get right back to work in a hurry to get the filings done.
And I think that about wraps up our webinar for today. Thanks to John and Jeremy, and you'll see on the screen they've got their phone numbers, their emails. Again, I'll be emailing out the slides, and I'll be sending around their contact information in case you have any questions that have come up. For those of you who would like CE, you'll be receiving an email within 3 business days with your certificate. And I'd like to thank you all for joining us, and we hope to see you on a future Armina webinar. Thanks so much.